Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Josh Lipton alongside Shauna Smith, live from our NYC headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The market does not like that the Fed does not want to cut as many times as the market wants. And this was a tantrum as far as we can see. And we think the market is already suggesting that we're getting good potential for a nice turnaround here.
We still have, if you look longer term, a positive view, and we see further advancement in the S&P as we move through 2025. I don't think any of this news flow adjusts that kind of thinking, because the fundamentals in terms of economic growth, employment data, earnings data remain pretty positive. I think this market was ready for a pause.
This is not as much about a government shutdown as it is the market kind of recalibrating their thoughts about how easy it's going to be for their new administration coming in to get their policies put through. I mean, a lot of this excitement that we've had in the market has been because of that, right? And now we're seeing already, maybe that's not going to be as easy as we thought.
We've got 1 hour to go until the closing bell. Let's take a look at where things stand, because it is a very different picture, Josh, than what we've been looking at the last couple of days. We actually got a rally going on in all three of the major averages. You got the Nasdaq up on the board right now. That's up just about 1.5%. Same goes for the Dow, up just about 1.5% on the day. You can see just off the highs of this session. The S&P also getting closer and closer to that 6,000 level. But let's take a look at that 5-day chart, because I think that really tells the picture and the story of what has played out in the market this week. Because you can see we are well off the lows that we hit back on Wednesday. That, of course, came after you guys were on air, and it was a Fed decision followed by House commentary. Some questions, some concerns about fewer rate hikes next year certainly was driving much of the action, but it seems like at least investors are getting a little bit more comfortable with it today as we hear from more policymakers.
Yeah, so we did get economic data today. We got PCE, the Fed's preferred inflation gauge, Sean. That came in muted, more in line with what Jay Powell would like to see. Thought it was also interesting to see the Fed's Austin Goolsbee. He was on the tape giving an interview saying he expects borrowing costs to fall a fair bit more over the next 12 to 18 months. That probably isn't hurting. Also have to talk about possibility of a government shutdown. How that matters as much. I mean, listen, investors have gotten used to those headlines over the years, but it does introduce more potential uncertainty here.
It certainly does. When you take a look at today's sector action, very much a risk-on sort of mentality you can see playing out. You've got all 11 of the S&P sectors moving to the SI. Actually, real estate, financials, technology among the winners here today. But you're exactly right. There's still so much uncertainty that's still playing out right now in the market. You've got the government shutdown potentially tonight. Investors very much have shrugged that off, at least for now. So it will be interesting to see as we go into the close. Then obviously looking ahead to next week, whether or not that sentiment could potentially shift once again.
So many questions, Shauna. I have just the man who's going to give us the answers. I do. It's encouraging inflation data out this morning, helping stocks continue to recover from Wednesday's steep post-Fed sell-off. Here to discuss, Sam Stovall, CFRA Research Chief Investment Strategist. Sam, it is great to see you on the show as always. So, Sam, just talking to Shauna there, we've got a rally on our hands as we head into the weekend here, Sam. Love to get your take on that PCE data. Came in muted, Sam. Give us your take on PCE and also just what you make, Sam, of the rally we are seeing here on Friday.
Hey, Josh and Shauna, good to talk to you. Yes, I was eavesdropping before you came to me, and I heard you talk about how the market is breathing a sigh of relief because the PCE came in a little softer than expected, not only on the headline level, but also at the core level. That's allowed the dollar to come back a little bit, allowed gold prices to move up, and along with the triple witching and the S&P 500 rebalancing, is making for a positive day. So we'll just have to wait and see whether this carries over into the Christmas week.
What do you think, Sam? Is it likely to last?
Well, I think that there's probably more shakeout to occur. Some investors probably were spooked by the action this week and had been anticipating that they would take profits in the new year because then they could delay the tax consequences, and maybe the president-elect Trump would come in with lower tax rates. But I think now some people are starting to say, let's take the money and run. So we could be in for a little volatile ride in the coming week.
So as you say, Sam, maybe a bit volatile in the near term. Let's go farther out, though, Sam. Let's say we're talking December 2025, Sam. We're back on the show. I have the SPX here, S&P 500. It's at 59.52 right here, Sam. Year-end 2025, Sam Stovall target. Walk me through it.
Okay, my target is 65.85, and based on my forecast for a 61.45 close for this year that I had made a while ago, that would only leave a 7% price appreciation. So yes, I am a bull, but with a lowercase b. I remind myself that third years of bull markets tend to be very challenging, that 3 of the 11 second-year bulls didn't make it to the third year. 2 more posted negative returns. We also had increased volatility with the first year of a president's term in office. And then lastly, basically only a 1 in 5 chance of us having a three-peat or 3 successive years of double-digit gains. So while I think it will be higher this time next year, it'll be a bumpy ride along the way.
Sam, I want to play. Our colleagues Madison Mills and Julie Hyman, they were able to speak with Oppenheimer's chief investment strategist John Stoltzfus earlier on this morning, talking about the market sell-off post-Fed. Here's what he had to say, and I want to get your reaction on the other side.
The market does not like that the Fed does not want to cut as many times as the market wants. This was a tantrum as far as we can see, and we think the market is already suggesting that we're getting good potential for a nice turnaround here.
So Sam, is this more of a tantrum really that has played out over the last couple of days? And when you pair that with that PCE print that we got out this morning, maybe inflation isn't as big of an issue as was initially feared just 48 hours ago.
I think that's certainly a possibility because also the Fed is still likely to cut at least 2 times in 2025. And there had been expectations across the board from 6 or 7 times that was forecast earlier in 2024. That got whittled down to a total of 100 basis point cuts that we've experienced thus far this year. So really the question is, do we maintain a strong economy, a resilient employment picture? Will earnings growth be double digits as is currently anticipated? And will the U.S. continue to be the best house on a otherwise bad block? So I would tend to say that we still have some upside potential, but if you are like myself, a bit of a conservative investor, I like to say that I wear a belt and suspenders, that you might want to play it a little more defensively next year than you have this year.
Sam, let's talk about the action in the bond market too. Yields dropping today, but the 10-year still, we're back to 4.52 here. When does that become, in your opinion, Sam, a challenge for the stock market? Is it 4.75? Is it 5? What's the level you look for?
Sure. Well, I like to go back in time and make some comparisons. Well, the average 10-year yield going back to the early 1950s has essentially been about 5.5%, 5.75%. So we're a good 100 plus basis points away from that. So, my feeling is that if we can continue with strong economic growth, good corporate earnings, and have the 10-year yield remain fairly elevated at this point, it's probably something that investors will be able to deal with, contend with, and live through.
Could they deal with 5%?
I think psychologically, at first, they would have a problem with 5%. But if we find that there has not been an adverse effect to home purchases, to consumer discretionary purchases, et cetera, then I think they will learn to live with it.
Sam, one final question for you. I think we have to talk about the possibility of this government shutdown, Sam. My friend, the great strategist, Peter Bukvar, Sam, this is what he told his clients this morning, Sam. He said, I've been doing this long enough not to care because a deal always gets done. And if the government does shut down for a short period of time, I guarantee that it will eventually reopen. How are you as a market strategist, Sam, thinking about this whole drama we're seeing unfolding in Washington?
Josh, it's more of a headline event than a bottom line event, in my opinion. A lot of the government shutdowns going back to the mid-1970s occurred over the weekends. And so as a result, it angered more tourists than it did traders. So interestingly enough, on the day before the actual shutdown, the market was off 0.3% on average. But during the entire period that the market was, or that the government was shut down, the market basically yawned. So I would tend to say it's something that investors really should not worry about at all.
All right, Sam, we learned so much about you here today. Wear a belt and suspenders, a bull with a lowercase b. We look forward to continuing the conversation here sometime soon. Sam Stovall, thanks so much for taking the time.
Thanks, Shauna.
With just hours until the midnight deadline, Speaker Mike Johnson saying that the House will vote on a new spending plan, quote unquote, soon, adding that we will not have a government shutdown. Here with more is Washington correspondent Ben Worschel. And Ben, it's great to get you here on the latest on that. I guess the question, how much progress? Is there some progress that's being made? It sounds like it.
Yeah, Johnson's comments just a few minutes ago were pretty optimistic. The thing to remember is this is take 3 on this. There was a failed effort on Wednesday, a failed effort on Thursday, and so this is another attempt to do it. What he's going to move forward on in a single bill, hopefully later this afternoon from his perspective, is 3 issues. One is a three-month government shutdown that would push it off until March, money for disaster relief, and then a smaller pot of money to help farmers. What is off the table, at least appears to be off the table right now, is the debt limit, which we've been talking about all week as well. So after President-elect Trump brought it up earlier this week, that appears to be off. Johnson is kind of pitching it to his members as a promise. A pinky swear might be a more apt metaphor to deal with it right at the beginning of Trump's term. Trump hasn't weighed in on that, so that's one of the big outstanding questions. But what Johnson is trying to do here is ram this through as a single bill in the next few hours. Very, very sort of unclear if it's going to succeed. It's got a lot of challenges still to go, but we've got about 9 hours to go for sure.
So Ben, let's play this out. If lawmakers are unable to reach a deal, what happens at midnight?
Yeah, two fronts to watch on that. If this vote doesn't happen on Congress, it goes through. The potential other route is something called the Rules Committee. One of the leaders there was actually floating to reporters in the last couple of hours a literal midnight hearing. So in terms of the midnight, what happens at midnight, there may be actual hearings in Congress. We can all set our DVRs for that. In terms of the economy, I think the thing that people will be watching, at least in the initial days, is the airports. That's always a big area for government shutdowns, TSA. Workers and flight and air traffic controllers are government employees. The TSA has sort of tried to assure people that the people will stay on the job, their paychecks get delayed, but there won't be delays, but that'll be a big question. As we've been sort of pointing out all this week, government shutdowns really have an economic effect when they're long-term. The most expensive one in history was about $3 billion permanently taken out, but that lasted 34 days. So it's a matter of we're a long ways from that at this point, but there'll be some effects this weekend, we'll see for sure.
Ben, always great to see you and have you on the show. Thank you.
Talk to you.
We are just getting started here on Market Domination. Coming up, a look at what's driving some of the top trending tickers on Yahoo Finance. Shares of BlackBerry securing an upgrade. It's after earnings. We'll discuss why later in the hour. Plus, we've got an energy-centric playbook with one investor's top picks in oil, gas, and nuclear. All that and more straight ahead on Market Domination. An inflation-concerned Fed spooked markets this week, leaving the major averages reeling. San Francisco Fed President Mary Daly joined Yahoo Finance's Brian Sozzi on the Opening Bid podcast with more insights on the central bank's inflation fight and rate-cutting cycle.
Does life after the pandemic, with these prices for many things still staying high, does it make it hard to perform what you do and do what you do and like we've seen over the past 2 years, bring down prices of stuff via the tools you have at your disposal?
Well, it actually is, monetary policy is working. And when I go out throughout my community, I have the 12th district, that's the 9 states in the western U.S., but you can go anywhere. You can go into New York, come here. You hear people saying that they do feel the relief of falling inflation. They just don't feel like it's perfect yet. We're not back to where they want to be, and I'm not back to where we want to be either. So we're working on that. But no, it doesn't make the job harder to have to do. What is hard is watching people struggle to pay for things and still feel the effects of the high inflation. So it's motivating. I get up every day working hard to help alleviate some of that discomfort.
Does it make it tougher or is it just going to take longer for policy to work its way through the system and bring prices down?
It really is about, we target inflation, and so what it really is about is we started with inflation really high, so even when we made progress, it still feels unsatisfying for people. Now, it is remarkable so far that we've been able to bring prices, inflation down so much, and the economy is still doing solidly, it's still expanding, growth is good, the labor market is good, wage growth is outpacing inflation. Today, personal income came out, it's positive. So I think that's all good news, but because people have been at this for so long, and we've been at it for so long, it still feels unsatisfying.
As a voting member on the FOMC, how does your brain work when you see the PCE index, like you mentioned here, come out, decelerated month over month? What's your first reaction, and how should investors interpret it?
I see this as just it's one data point, so I really don't think we should get too excited about any one data point. What we've noticed is that, inflation progress has been bumpy this year, so I see the PCE report today as good news. I was really pleased to see that real incomes went up. Spending continues to go up. If you're out in New York, you can see people are out there buying presents.
Buying handbags, I see it all over the place.
They're buying everything, and we were at the restaurant last night. It's standing room only there. So I think there's a lot of enthusiasm for the economy, but you still feel that struggle of inflation. So I see a positive data point as a good thing, but I never overreact to one data point. That's a recipe for making mistakes.
True. You voted for the latest, 25 basis point rate cut. Why did you do that?
We have recognizing the progress on inflation, recognizing the labor market's now balanced, well balanced. There's one job opening for every unemployed worker. That's a perfect balance. And also the economy we're projecting to have, where we have solid labor force growth, labor expansion, and we have inflation continuing to need to come down. So I see the recalibration period now as completed. We are back to the time when we can make our decisions more slowly, data dependent, using the data to affect the incoming forecast, and determine how many rate cuts we'll ultimately do next year. We'll have to be agile and data dependent.
Yeah, and it was those forecasts that I think spooked investors.
A little bit.
A little, yeah, just a little bit here. We saw the action on our platform, expecting 2 rate cuts next year was the consensus. Does policy still have to stay restrictive next year to bring down inflation?
It does, I think. That's my best projection. I mean, we might get really positive inflation news, and we'll react to that if we do. But I do think that we want to make sure we finish the job. The history tells us that resolute behavior to finish the job and get inflation completely to 2. Americans depend on it. That's also part of our trust and credibility, and that really helps us. So we are resolute to get that job done, and that will mean restrictive policy through the year in all likelihood.
Can you rule out a rate hike? Because I know Fed Chair Jerome Powell, he made his case clear. How do you think about it?
Well, I never rule out anything, honestly, because that's a recipe for being behind or making mistakes. So I don't rule anything out, but I can tell you where I think the most likely place will be. We could have fewer cuts than 2, We could have more cuts than 2, depending on the data. Of course, if inflation, for whatever reason, started to accelerate again, then absolutely I'd be supportive of adjusting the rate upwards. But I don't see that right now on the horizon. But that absolutely would be how we would respond if we saw a re-acceleration of inflation.
The Fed's message this week to expect fewer cuts in 2025 led to a wild ride on Wall Street, to say the least, as investors price in higher for longer. Here with what to expect next, we want to bring in Julian McManus, a Janus Henderson Investors portfolio manager. It's great to have you here. So let's talk about what we just heard from Fed President Mary Daly. She very much was adamant about the fact that she thought that 25 basis point reduction was the right move, reiterated the fact that we do need to remain restrictive in order to get inflation under control. I'm curious, do you agree with the Fed stance and kind of what that path forward looks like here over the next potential 12 months?
Yes, I do. With the caveat that I'm a bottom-up equity portfolio manager rather than a fixed income expert, I will go out on a limb and say I agree that getting the job finished on inflation is really important, and that last mile historically has proven to be the most difficult. And the pitfalls in the past have been in letting up too soon and declaring victory before the job was finished, only to see inflation flare up again.
And Julian, though, when you saw the Fed decision, when you saw what the Fed did and said on Wednesday, and then you saw that reaction, were you, like I think a few different folks, were you surprised by how the market seemed surprised?
I wasn't terribly surprised by the way that the Fed articulated the way they were thinking. I think they were very measured around how they were becoming more cautious around easing policy restraint. I will say I think the market overreacted a little bit in terms of just looking at the equity market in the U.S. The air pocket it hit showed, I think, an excessive reaction. And when you compare it to the way that international markets reacted in the aftermath of that, they were a lot more muted in their reaction. So, and today's move in the U.S., I think, is suggestive of that overreaction. It's somewhat correcting for that.
And Julian, also just given the spike that we did see in volatility, I guess, how do investors then build that resilient portfolio given the number of uncertainties that lie ahead?
Well, I mean, I think you hit the nail on the head. Volatility and resilience are key words that investors need to have in mind when they construct portfolios. I think we are just endemically heading into what is going to be a higher volatility regime. I think for the next year or so, we can expect higher volatility around what policymakers do and the way that currencies and risk assets react to that.
And how do you position for that, Julian, in the stock market?
Yeah, so the way that we approach it is through very thoughtful portfolio construction. First of all, isolating stock selection as the source of risk. And so we want idiosyncratic risk or stock-specific risk to be driving returns. And then secondly, I think a thoughtful approach to risk on a go-forward basis. So thinking through what are the major risks facing the portfolio and picking stocks that can be resilient in the face of that. So one might use examples of, say, defense stocks, both in the US and overseas, and stable free cash flowing stocks like such as telecoms and utilities, where there still remains a lot of value in the market.
Yeah, Julian, I guess for investors that are trying to take advantage of some of that gaps and some of the gaps that we've seen in terms of valuation and set up here for a second Trump administration, I guess how much of that has already been priced in when you take a look at the news, or is that now factored out just given some of the losses that we did see going back to Wednesday?
I think in the U.S., I think the market's pricing in a very benign outlook, primarily keying off of President Trump's America First mantra and assuming that American companies are going to be large beneficiaries of policy in future. I would contrast that with what we're seeing outside of the U.S., where a lot of international markets have seen capital outflows in response. That's why The US is up 3% and over the last quarter, and Europe is down 3% quarter to date. So you're seeing capital move already very decisively based on that. But I think you're also seeing some really interesting opportunities in terms of babies being thrown out with bathwater outside the US.
Such as what, Julian? Can you name some babies there?
Yes, so I mean, examples that are top of mind are, for example, banks in Europe, particularly those that are exposed to Eastern Europe, where if there's any peace settlement reached in Ukraine, you can expect that the reconstruction of Ukraine is going to benefit Eastern European economies greatly, particularly financials. That's definitely not priced in by the market. Similarly, defense stocks around the world, even if we reach a peace settlement in Ukraine quite quickly here, defense in the rest of the world needs to catch up with what's been driven by the US. For example, the US contributes 2/3 of NATO's budget, and Europe 1/3. That ratio probably needs to flip. So defense spending needs to pick up and catch up. And so UK defense companies, for example, are very attractively priced. And then there are more idiosyncratic opportunities around the world where, again, great businesses have been thrown out with the bathwater, largely because of where they're domiciled, such as the UK. So there's a fantastic pest control company domiciled in the UK that trades at a third of the valuation of the US leader, Rollins. And that spread, in my opinion, is just too great considering the quality of the businesses.
Julian, great to have you on the show today. Enjoy the weekend and happy holidays.
Thanks. Happy holidays to you too.
All right, now time for some of today's top trending tickers, sponsored by Tasty Trade, and you can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up, let's take a look here at shares of Novo Nordisk as the company's next generation obesity drug posts disappointing results. You can see we're down there about 17%. Shares falling actually the most on record in today's trade. News here, experimental obesity shot apparently helped patients lose an average of 20.4% of their weight over 68 weeks, Shauna, and that was short of the 25% weight loss that the company had predicted. And you can see the reaction here.
Yeah, I think this is just pretty simple. Just the consensus expectations were obviously too high. We're seeing that play out now in the market. I think the big question now is this race between Novo and Eli Lilly and who has the advantage. And what's really stuck out to me in terms of some of the commentary that we've gotten throughout the day from analysts who are covering both of these stocks is they're very optimistic about the outlook now on Eli Lilly. Mizuho is out saying that Lilly is now the prominent player within the market. Citi calling it a nearly best case scenario because Novo's shock could have eroded Eli Lilly's market share. That was one of the fears that had surrounded Eli Lilly going into the new year. So again, we're seeing the sell-off happen within Novo Nordisk. We're seeing a bit of a move to the upside here in Eli Lilly. I think when it comes to the degree of the drop for Novo Nordisk, one of the questions that I've seen a couple of times posed by analysts here today is whether or not that's justified, whether or not we are seeing a bit of an overreaction here at this point. I think that's going to be the important thing to keep in mind as we look ahead to the next couple of trading days, whether or not we do see a bit of a bounce back as the market does take some time to digest this news.
Yeah, and of course, this year, this was such a big theme. Investors were so interested and excited about the weight loss market. As we end the year here, I mean, Novo deep in the red for the year. Lilly, on the other hand, surging about 35%.
All right, let's turn now to Volkswagen. The automaker and employee representatives are reaching a labor deal. Now, this comes after grueling negotiations. You're looking at gains of just about 2.5%. This caps 3 months of those intense negotiations. They were able to reach a deal. They're cutting capacity. They're going to avoid factory closures. It looks like at least the street is taking a look at this as pretty encouraging here. VW has agreed to keep the brand's 10 German factories operational, also reinstate job security here agreements until 2030. As a result, workers did agree to forego some of the bonuses. They cut capacity at 5 sites by several 100,000 units. They're also reducing the workforce by more than 35,000 over the next 5 years. Looking out to 2025, though, the question is how big of an impact that's going to have on outlook. At least for now, looks like 2024 won't be materially impacted.
Yeah, the measures should lead to about $4 billion in savings per year in the medium term. Company, though, to your point, Shai, it still faces real challenges. Bloomberg has a good write-up emphasizing dwindling share in China, slowing demand for EVs in the U.S. and Europe. Company saying in a statement, this is the company's response to the declining automotive market in Europe and the increasingly intense competition, while at the same time creating the basic prerequisites for continuing to produce successfully at its home base in Germany.
Yeah, certainly. It's tough competition out there, especially when you take into account the fact that the EV adoption has remained slower than what was initially anticipated. We've seen a number of these automakers being forced to pivot just a bit, so they've been under just a bit of pressure. All right, coming up next, JMP Securities upgrading a firm on growth potential. We're going to bring you the details from that call next. That's coming up on Market Domination. Let's get to some calls of the day. JMP Securities upgrading a firm from market perform to market outperform. The note calling a firm a long-term winner at the expense of the credit card industry. And this is a stock that has outperformed. It surged 38% following its most recent earnings results. When you take a look at why they are so positive on this name going forward, obviously it's at the expense of some of those credit card companies, but they talk about the strong position to capitalize on their growing adoption of the buy now, pay later space. And they talk about the competitive advantage right now of a more robust platform, a loan platform, when you compare it to some of their peers. And I think that's a real differentiating factor there, Josh.
Yeah, they do acknowledge the stock has surged since it's the election and the company's Q1 results, but they say, you know what, we're not discouraged by that. We're constructive on the shares at current levels. Other reasons for optimism on the name, they talk to their clients about expectations for benign regulatory landscape under the incoming Trump administration. They talk about quicker than previously expected outlook for the transition to GAAP profitability in 25 and momentum in new partnerships. Lots of reasons to get bullish, they say, Sean. All right, moving on. TD Cowen upgrading BlackBerry from hold to buy, the note highlighting the company's low valuation, among other reasons. So BlackBerry did report Q3 results. In terms of analyst reaction, it was interesting. I mean, TD Cowen does upgrade a buy. Target goes to 4. They talk about how results were better than expected. We can't ignore, they say, the substantial improvement in the expected free cash flow generation from the entire business. The upgrade, they say, does reflect low valuation and significantly improved cash flow expectations, Shauna.
Yeah, the cash flow expectations were really front and center of this note. They talked about the low valuations, like you said. Their price target, though, just about $4, not too far from where we are trading here today. Obviously, a rally on the heels of this call. They also talked about the attractive deal here, the Silence divestment, providing a favorable exit, also just bolstering their financial profile here going forward. Undervalued shares when it comes to the current valuation. They're saying that it represents an opportunity, especially when you take a look at the potential growth opportunity here of Internet of Things. They very much see BlackBerry as a market leader within this space. So BlackBerry is still around.
Although not everyone's in love, Shauna. Not everyone. RBC rates this one sector performs, so they're on the sidelines. They were telling their clients, yes, the quarter exceeded their estimates, but Q4 guidance, they say, was short of what they were looking for. They say company, yes, it's profitable, operating cash flow positive, but valuation, here's their bet, likely to remain discounted below peers pending improved IoT growth.
All right, we will see who is right. Only time is going to tell. Our President-elect Donald Trump may get a tailwind in 2025 when it comes to his wish for lower energy prices. Wall Street is forecasting crude prices to go down next year. Joining us now, we want to bring Yahoo Finance senior markets reporter Ines Ferre. Hey, Ines.
Hey, yeah, and Wall Street analysts are forecasting that crude will go down next year. Brent crude, and specifically, right now it's averaging around $80 for 2024. But for next year, depending on which analysts you pay attention to, that could range anywhere between $76. Goldman Sachs saying that Brent is going to average $76 next year. You've got JP Morgan saying $73 per barrel next year, and B of A with a more bearish view of $65 per barrel. And part of this is because of an oversupply in the market, more supply from non-OPEC nations. Demand growth is supposed to slow to 1.1 million barrels per day, but supply is supposed to grow more than that. It's supposed to surge to 1.8 million barrels per day. And part of that is because of offshore drilling in places like Brazil, Guyana, Norway. So that's supposed to increase supply. And then you've got OPEC Plus and the spare capacity from OPEC Plus, which has delayed putting more barrels into the market. And OPEC has indicated that they want to put more barrels in eventually. I mean, they do not want to keep losing market share. The big wild card is going to be Iran and Venezuela, and whether Trump tries to limit exports the way he did during Trump 1.0. But JP Morgan analysts are saying that his main objective is to bring down energy prices, and they believe that he may continue on with what the Biden administration has done, which is an easier stance on those countries in order to lower prices. Even if you take a look at gasoline prices, those are projected to go lower next year. They've been trending lower. Now, he wants them to go to sub $2 per gallon. And I spoke to one analyst that said, you need a major calamity for that to happen. That's not going to happen. But certainly, the EIA is predicting that they're going to go lower next year somewhat.
All right. Thank you, Inez. Appreciate it.
Thank you.
We're seeing a lot of moves in the energy industry with geopolitical tensions and a second term for President-elect Donald Trump on the horizon. And another player in nuclear is entering the ring and sending some industry names soaring this year. We're navigating how to play the energy sector with the Yahoo Finance Playbook. Joining us now is Dan Pickering, founder and chief investment officer at Pickering Energy Partners. Dan, it's good to see you. So let's start with politics, Dan, because Trump is moving back into the White House. That has potential different ripple effects for the energy sector. One bet of course, Dan, investors have been making is that this is going to mean a friendlier regulatory backdrop. I'm just wondering, against that, Dan, would you be expecting to see more M&A, more deal making in the energy sector over the next couple of years?
Yeah, great question, Josh. Glad to be here. Without a doubt, the Trump administration is going to be friendlier to the conventional oil and gas sector. As Inez just mentioned, maybe prices are lower. Consolidation, it's been very active with companies buying each other in 23 and 24. We think more of the same in 25, particularly with a friendlier FTC. And so I think you should expect companies looking at trying to get bigger, trying to capture the attention of investors. And really, this is all happening at pretty inexpensive valuations, 3, 4, 5 times cash flows. So expect to see more deals as we go into 2025.
And Dan, when you take a look at energy stocks, the majority of them are still cheap at these levels. So is now the buying opportunity then? And I guess so, what is that common thread that investors should be looking for when they're trying to identify the best plays in the space?
Yeah, when we look at 25, I think potentially the risk here is that you have very inexpensive stocks that are generating, high free cash flow yields, and will investors care? It was the same story in 24. The sector's underperformed pretty dramatically, but up a lot less than the market. As we go into 25, I think you have to be a stock picker in the face of an okay but not great oil and gas price environment. And so I think you look for companies that have a stock-specific story.
And what would be some examples of that, Dan?
Yeah, when we look at the space, we like things like Diamondback Energy, which is a Permian producer that made a really big acquisition in 2024. They're going to be taking out costs. The Permian Basin is a low-cost area. They are the crown jewel. Eventually, they'll be a target. We look at names like Conoco that's underperformed this year, that's very inexpensive. Another name in clean energy is GE Vernova, a spin-out from GE. That stock, although it's not cheap, really has tailwinds in terms of where spending's happening. So those are stock-specific stories that don't necessarily need higher oil or gas prices to work.
I was going to say, Dan, what's the catalyst, though, that's necessary in order to see a broader turnaround within the sector and not so stock-specific when it comes to some of those outperformers?
Yeah, when we look at what does it take, we either need to see much higher commodity prices, which is probably something related to a Middle East conflict and a true disruption of oil supply. I'd put a relatively low probability on that, but who knows? It's a geopolitical wild card. And then the other would be some sort of resurgence of inflation that pulls money away from the kind of current high flyers and more toward value and potentially inflation impacted stocks. So you need the current market environment to change. I don't know if we're going to get that. And so that goes back to the stock picking. Beta may work. Alpha hopefully certainly works.
Dan, one other Trump theme I just want your 2 cents on. It has become, and this, a Republican mantra, right? Drill, baby, drill. Do you believe we're going to see a pickup in U.S. production? We have had other, smart folks like yourself, Dan, who know this sector very well, who don't think we're going to see that, but I'm interested to get your take.
Yeah, no chance for drill, baby, drill. Oil was 120 in the Biden administration. He asked for drill, baby, drill, and the industry didn't do it. We now have lower prices, maybe potentially weaker supply-demand fundamentals. Drill, baby, drill doesn't work for the industry. And so I think it's unlikely to see an uptick in drilling activity. Supply grows a little bit because of efficiencies and drilling in the best basins, but I don't think there's a very high probability at all that we're going to see a meaningful uptick in activity in 2025.
Dan, sticking with Trump policies and more so what he has said about the EV space, obviously he wants to repeal some of the benefits. We talked about the fact that he has said that is important, obviously, for the future, but doesn't seem to be too concerned just in terms of motivating Americans to buy EVs right now. Is that enough for you to stay on the sidelines when it comes to some of these EV makers?
Yeah, the EV OEMs and potentially the charging companies, it's a great idea whose time is still yet to come. It's growing, but growing more slowly than expected. EVs are still expensive relative to gasoline-powered cars, and the subsidies are likely to get removed, supported, by the way, by Elon Musk, as he helps President Trump. And so the EV makers, they're Tesla is very expensive. Rivian looks way too expensive to me, given all the money they're going to have to spend. So I'm on the sidelines with the EV makers.
All right, that's EV makers. Another theme I want your take on, Dan, all things nuclear. As you know, lots of interest, lots of excitement. Do you want to own any of those names right here, Dan?
Yeah, I do, but not now. When I think about nuke, it is the best long-term energy story out there, but it is very long-term. Think 2030 plus. And so there's been a lot of hype. All of the hyperscalers have been announcing deals with the nuclear companies, and those stocks are up a lot this year, too much, most likely. The reality is it is 5 to 8 years before the real revenues start to flow from those contracts, assuming the technology plays out. And so nuclear is a great theme that's a little too expensive right now from my perspective.
All right, Dan, we have to leave it there. Dan Pickering, thanks so much. Coming up, we'll discuss what 2025 may bring for health insurers and the media industry. We've got those look aheads next on Market Domination. We're just minutes away from the closing bell on Wall Street. Let's take a look at the major averages right now. We are seeing certainly a rally across the board off the highs of the session, but you got the Dow up just around 1.2%. You've got the Nasdaq and the S&P 500 up just about 1%. We certainly have seen a bit of a bounce back here today following the better than expected PCE number that we got out this morning when it comes to inflation. Looking ahead to some of the commentary that we also got from Fed officials, the San Francisco Fed President Mary Daly was also on Yahoo Finance earlier earlier today, just talking about the path forward here for the Fed. That's helping to reassure the markets just a bit. You're seeing investors a little bit more optimistic that maybe rates are going to still come down. Let's flip over to the bond market here. You've got the 10-year yield pulling back just a bit. It's off about 5 basis points, still just above that 4.5 level.
All right, it's been a wild year for health insurers, and 2025 might not be any less volatile. Joining us now with more is Yahoo Finance's Anjali Kamlani. Anj.
That's right, guys. We know that the health insurers we've seen at least towards the end of the year have had it pretty tough, but it's started off that way, starting with the higher utilization that we saw in the Medicare Advantage, so seniors getting more care, what seemed to be a post-pandemic increase. Then you saw profits getting squeezed. As a result of that, a lot of FTC scrutiny, especially on the larger players like CVS and United Health, and a little bit of activist investor activity pushing the boundaries there. So it's been an interesting year for them. 2025, kind of a mixed bag. You've got the new administration, so the Trump administration and whatever policies come out there, premiums increasing potentially, greater enrollment and revenues from that. So those are some of the tailwinds. Meanwhile, you still have some concerns about that greater usage and utilization and what will be the Trump administration's policy on GLP-1 coverage. Will they pull back? Will they increase? We know we've got some fans in the mix from some of the nominees. So that's something to look at on how it all pans out. Now, I'd like to also particularly look at United Health. We know that company has had a really tough year between the cyber attack and the hit that it had on finances there, and then ending the year with the tragic shooting of an executive, really creating an interesting space for the industry to have some sort of reckoning on how it operates. We know that leaders are talking about it right now, but that may not have any near-term impacts. We will see, however, how the companies recover from this higher utilization and the Medicare pressures that they have faced this year. One specific metric to look at is the MLR, medical loss ratio. Since 2020, when there was a really stark reduction in utilization, we've seen growing MLR from year to year. And what that is more of the premiums that come in are paid out. You can see there on your screen specifically the stark difference between the largest player, United Health Group, and then another big company like Cigna. They're still pretty close when it comes to that MLR, and that just tells you how much more they're paying out. And this is also what impacts and squeezes profits a little bit, has a little bit to do with that. So all told, interesting year. In some parts, really frustrating for those insurers trying to think about pricing, trying to think about how to keep members on board, and what does that look like in a new administration that's very actively focused on the health industry. One to watch?
Certainly is. All right, Anj, thanks. Let's turn now to the media industry. While 2024 has seen low deal volumes, the tide might actually be turning for the coming year for deal making among media and entertainment companies. Yahoo Finance's Alexandra Canal joining us now with the details. Allie, is 2025 the year?
Yeah, well, that's what I've been hearing. I mean, the rating has sort of been on the wall that we're reaching more media consolidation and that was going to start to pick up. 2025, though, looks like the perfect storm. That's actually how one expert I spoke with described the anticipation. There's a few reasons for this. One being the significant dry powder that's been on the sidelines. We have private equity, other entities that have been waiting to really make deals. That's led to a lot of pent-up demand. Also, the expectation that interest rates will continue to move lower. Maybe not at the rate we originally thought, but still lower over the course of next year. And perhaps one of the most important tailwinds, a looser regulatory environment from the incoming Trump administration. Now, we've already started to see some moves from market players like Comcast, for example. Comcast is spinning off most of its cable properties into a new publicly traded company. Warner Brothers Discovery also recently announced that it will be separating its own legacy networks from its studios and streaming business. Big reason for that is that cord cutting has really emphasized the downward trends that we're seeing, and these companies want to focus on the growth drivers of the business as traditional TV just continues to decline. Wall Street analysts have said that Comcast's new spin-off business, which has been dubbed SpinCo for now, they could potentially go out there and purchase other beaten-down cable properties. I also recently spoke with the CEO of Starz, who said they might want to be a buyer of linear assets. Remember, Starz will finally complete that separation from Lionsgate Studios early next year, so they will have its own balance sheet and potential ways to structure future deals. So that's all fueling optimism that more deals will get done. And then real quickly, I did mention that looser regulatory environment, and we know Trump has been generally viewed as more friendly toward deal making compared to Biden. He recently appointed Brendan Carr as the new chair of the FCC. Carr has frequently advocated for deregulation and an intent to revisit ownership caps for local broadcast stations. So there's a change in the tide of sorts, and that is coming at a time when Hollywood is really ready to shake things up. They want to clean up their balance sheets, they want to refocus their strategies, and they want to get rid of those things that are no longer serving them, i.e. those traditional assets. Obviously, there's a lot of ways that these M&A moves could play out. TBD on who the buyers will be, who the sellers will be. But from the sources that I've been speaking with, it seems like more of an inevitability rather than a possibility at this point.
All right, lots of moving chess pieces. Thank you, Allie. Appreciate it. While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
And that's the closing bell on Wall Street. And now it's market domination overtime. Taking a look at the major averages and where things stand, we're seeing gains across the board. All three of the major averages closing to the upside. You've got the Dow, the S&P, and the Nasdaq all gaining just about 1%. The Dow, the outperformer of the three major averages. We're joined now by Ines Ferre to get you up to speed on the action that we saw from today's trade. Ines.
Yeah, Shauna, and just taking a look at the sector action, I want to point out what we've seen today. We've seen the sectors of the S&P 500 all in the green. We've spoken a lot about the market breadth before the drawdown that we saw on Wednesday, Fed Day. But today's action, we've seen in the S&P 500 more than 90% of the index rising. So the breadth of the rally today has been significant, the best it's been since around March. Taking a look at the Nasdaq Composite, we're we're just taking a look at some of the movers today. Tesla in the last hour of trading really going down that last hour, down 3%, but it had been trading in positive territory for most of the session. Nvidia up more than 3%, Apple, Amazon also higher. Remember that we're not too far off the highs of some of these stocks that we have seen, but let's just pull up the 5-day chart so we can see the damage that was done in the volatility that we saw earlier this week. We're looking that for the week, Tesla's down, but you've got Apple and Meta up, Google as well, even Nvidia eking out a gain for the week. And then just taking a look at the Dow, just want to show you where we're at with some of the Dow components. You can see here the Dow had been on a long losing streak, then it eked out a little gain. Today it did see some gains, but when we take a look at the major averages for the week, we are seeing losses across the board for the S&P 500. The Nasdaq down 1.7% for the week, and the Dow also down more than 2% for the last 5 trading days, guys.
Thank you, Nis. The market closing out a roller coaster week on an upbeat note, a slightly better than expected reading on inflation, helping boost sentiment on Wall Street, but stocks still down on the week after that major sell-off on the Fed decision. Joining us now is Phil Orlando, Federated Hermes Chief Equity Strategist. Phil, always good to see you. So let's start with the Fed. Phil, obviously this week, listen, they signal fewer cuts coming. You say, Phil, it's clear to you now that the Fed really did miscalculate when they gave us that supersized cut in September. How come, Phil? Why do you say that?
So first of all, Josh, thank you very much for having me back on the program. If we go back to September, I think the Federal Reserve was to some degree lulled into a false sense of security that the inflation metrics were well behaved and that the labor market was materially slowing. We now know, with the benefit of hindsight, that a lot of the labor market weakness was probably related to a couple of strikes and certainly to hurricanes Milton and Helene. We also know that inflation has been very sticky and persistent and has actually resurged in recent months. So the Federal Reserve at Wednesday's meeting sort of looked at the current data. I think to some degree they were a little bit surprised that inflation was as strong as it was, that the labor market was as strong as it was, and I think that's why they pulled 2 of their the cuts off the table for calendar 25 based upon what they had told us in the September SEP. So I think the shock to the market was not the fact that the Fed cut by a quarter point on Wednesday. That was widely assumed. Also, the changes they made to the SEP, inflation up, GDP up, rate of unemployment down, that wasn't a surprise either. It was the reaction of taking, 2 cuts off the table, and the market is now pricing in that they think the Fed could be done cutting interest rates, by the middle of next year.
Phil, we also had the comments from Chicago Fed President Austin Goolsbee earlier today talking about the fact that rates can still go down a fair amount next year. That seemed to add a little bit of optimistic sentiment, I think it's safe to say, in the market, at least today. When you take a look at the gains that we saw, or at least the encouragement that we saw play out on the street today, is there enough to carry that through? And I guess, what do you see the next couple of weeks looking like?
Sure. So remember, we were down about 3% on Wednesday, so we were due for a little bit of a snapback. And Goolsbee's comments certainly, I think, helped to some degree alleviate some of the concerns. But, if Dr. Goolsbee's comments are going to be right, that means that we're going to have to see a reduction in inflation next year and possibly a weakened labor market to expect that the Fed is going to cut more than 2 times, let's say 3 or 4 times over the course of next year, and then more into 26 and 27. That seems to be sort of an aggressive bet at this point and somewhat of an unknown bet given the recent trajectory of data. So as we look at over the balance of the year, it's going to get very slow. A lot of us are going to be on vacation. Volumes are going to be very, very soft. It's really not going to be until we get back to the week of January 6th when everyone comes back to work, school vacations are over, et cetera, when we're going to see a normal amount of volatility. And that's the point where the market is going to have a more normal trading pattern and dictate a more normal direction.
Phil, I also want your take on what we saw in the bond market this week. I mean, yields down a bit today, Phil, but the benchmark 10-year, we still backed up here, 4.53. I'm curious, Phil, why do you think that is? What are the reasons? What's driving that? In your opinion, is that because inflation is looking a bit more sticky here?
Oh, there's no question. You look at Wednesday's activity, benchmark 10s went from like 435 to 455 in the space of a couple of hours. That's a huge move in bond land. The stock market, we mentioned, is down about 3%. And the VIX, the volatility index, roughly doubled from 14 to 28. But those are extraordinary moves. And I think to a significant degree, the Federal Reserve's acknowledgement that inflation was a lot stickier and more persistent was a problem. Just look at one metric as an example, the wholesale inflation, the core PPI, the production index, has gone from 1.8% last December. That number is now sitting at 3.4% here in November. We've seen a near doubling in wholesale inflation over the course of the last year. Now, in my way of thinking, some of that increase in wholesale inflation, it's filtered its way into retail inflation. We've seen the improvement in retail inflation, the consumer price index, sort of stall out here over the last couple of months. Same story with the Personal Consumption Expenditure Index, where we're sitting here now at 2.8% in November of this year. The Fed's target is 2%. And in the SEP on Wednesday, they acknowledged that we're not going to get to their target until the end of calendar 27. That was a surprise to the market, and I think to a significant degree, that's what sparked the significant sell-off in bonds.
So, Phil, what does that then tell us about positioning? Because here we are, we've obviously seen that tech has been able to weather the higher interest rate environment. They've very much viewed as almost a defensive play because of that outperformance. Is that once again going to be a top play as you look into the fact that maybe rates aren't going to come down as much as initially anticipated?
Well, I like the last part of your comment that maybe rates don't come down as much as the market originally thought. I think that sparked some of the volatility this week. But you've also got to remember that a lot of the large growth and technology names, the Mag 7 names in particular, have had a phenomenal run here over the last 2 years. And maybe those valuations have gotten a little ahead of themselves. So as the market sort of right-sizes itself, we would expect that the correction in these Mag 7 names might be, significantly greater than the corrections in the rest of the market. Now, that said, we've still got a bullish longer-term view. We think the S&P 500, a year from now, give or take, is going to be up around the 7,000 level. So any correction that we see here over, next couple of weeks or so, from our perspective, would be refreshing. It would be well anticipated. It would be needed to take some of the froth off of the valuation premium that's been built in. So the stocks that have underperformed, domestic large cap value, the small cap names, the emerging market names, those are the names that we think will probably hold up better here because they're cheaper, Ps are lower, less volatility, higher dividend yields. They don't have nearly as much as far to fall as some of these Mag 7 names that, frankly, have gone vertical the last couple of years.
All right, Phil Orlando, always great to get your insight. Thanks so much for taking the time to join us here this afternoon.
Merry Christmas to you. Merry
Christmas to you as well. The U.S. government is hours away from shutting down potentially unless Congress agrees to a spending plan. The House failed Thursday to pass a new Donald Trump-backed GOP proposal to fund the government into March. But now it appears that House Speaker Mike Johnson is trying to broker a deal with Democrats to get a funding bill passed to avert a shutdown. Joining us now is former Congressman Patrick Murphy. He's also the co-host of Warrior Money right here on Yahoo Finance. Congressman, it's great to have you here at the desk. Let's talk about where things stand right now on Capitol Hill. It sounds like maybe we are seeing some progress here from Speaker Johnson just in terms of what those talks look like. I guess you've been there before. What can we expect to play out?
Well, first, I think most markets should be upset. I mean, the budget started October 1st, right? So they're already 3 months behind schedule of this fiscal year. And, they had a deal, they didn't have a deal to get passed. And listen, I'm hopeful. And the deal that looks like it's going to extend it to March 14th. It's going to have some farm bill funding in there. It's not going to touch a debt ceiling. So am I hopeful? Yes. Do I think they're going to get out of Dodge? They want to go home to their families too for Christmas. Yeah, I think they'll get something passed. But I will tell you, there's another thing that came out of the House caucus, Republican House caucus today that said, hey, we're going to raise the debt ceiling when we come back about $1.5 trillion. But to do that, we're going to cut $2.5 trillion in mandatory spending. So people are like, okay, well, mandatory spending. Well, you know what that is? That is Social Security, Medicare, Medicaid. So, attacking your seniors like that, that's not what people voted for November 5th. That's not the change you were looking for.
Let me ask you, Patrick, also just curious about the role Elon Musk is playing here. Active, engaged, posting on X, seems to be having an impact. As a former congressman, what do you make of that?
Well, first, he's not elected. And listen, I teach, at the Wharton Business School. He's a graduate of Wharton. We a lot of us appreciate his business acumen. But when he says, hey, I'm going to be ahead of Doge, and I'm for getting rid of fiscal, wasteful spending. But the fact that he's kind of co-president here is kind of disturbing, and it goes against the very fabric of democracy. It's for elected officials or representatives of America. Now, listen, most congressmen, like when I was in Congress, I wasn't a millionaire. I was in the Army for a long time, right? I believe in public service. Most members of Congress are millionaires, and they're older, et cetera. But I think there's a lot of people that are, they're not $600 billion wealthy like Elon, but I think there's a lot of folks that are having a real heartburn about the role he's playing.
I want to switch gears here too, Patrick. Monday, big deadline for that Nippon U.S. Steel deal to get approved. And you think President Biden should do just that? He should greenlight this deal. How come?
Absolutely. Listen, it's personal. It's personal for folks like Sean and myself. Why? Because we're from Bucks County, Pennsylvania. And in Bucks County, Pennsylvania, we used to have Fairless Works, about 10,000 steel workers in Bucks County. Now there's 100, right? Manufacturing has been decimated, right? So here you have Nippon who wants to buy U.S. Steel for about $14.9 billion. They have promised that they're going to invest another $2.7 billion in American steel workers here in America. They already have factories in America. They're already union factories and union workers. The fact that this has been held up for over a year, I really hope that the CFIUS recommendation that goes to President Biden should absolutely be, it's in our national security interest to invest in American manufacturing. I worked in a factory before I joined the Army, Josh. It is important to make sure we're investing in it now, not wait till we're in war 5, 10, 20 years down the line.
All right, Patrick, thanks so much for your time today. Appreciate it and the insight.
Yeah, thanks, Josh. Thanks, Shauna.
And be sure to scan the QR code below to stay up to date with new episodes of Warrior Money. Here is a look at the newest episode.
Bluff, bottom line up front. What does corporate America need to know about the American veteran?
American veterans are incredible talent pipeline. They're strategic assets that are key leaders that employers should be hiring today. They bring their amazing knowledge and experience and skill sets and their ability to problem solve and make things happen. And that was the whole purpose of the survey. As I got into veteran employment after the passing of my father in 2013, I constantly ran into these misperceptions about the veterans being perceived as heroes rather than strategic assets.
Fed-induced sell-off earlier this week left the major averages reeling. Tech stocks among the hardest hit. The Nasdaq Composite seeing its largest one-day percentage decline since July. Our next guest pointing to options as part of investors' exposure to tech, suggesting to proceed with some cautious optimism next year in 2025. Howard Chan, he's a Curve Invest CEO and founder, joining us now for the Options Playbook, sponsored by Tasty Trade. Howard, it's great to have you here. So let's start with just your overall view here, this cautious optimism that you're seeing right now. We certainly saw a bit of a sell-off earlier this week. I guess it's not so much a question of whether or not it's going to happen, it's when it's going to happen in your mind in terms of a larger correction in tech. What's going to trigger that?
Great to be here, Julie. And you're right. Our thesis is the correction is not if, but when. And just to be clear, we think many of these tech companies are fundamentally strong. A lot of the stock appreciation this year has been backed by increase in earnings. But even since the run-up since November, we think that the valuation has been stretched quite a bit. And so we don't think we're going to have a major correction, but the market does need to exhale a little bit before it can inhale again.
And so given that view, Howard, you say take two different approaches, right? Single tech stock or basket of tech stocks. Walk us through that.
Yeah, I think if you have holdings in a basket of tech stocks, I think it's important that people don't move out of the tech sector. I think, in July, we heard this narrative in terms of this rotation from mega cap tech stock to small cap. And if you did that, I think advisors face two problems, which is one, it's hard to reallocate back. Timing is always a little bit tricky. And many of these tech stocks have had pretty good gains for the 2024. So when you allocate that out, you face a bit of a tax bill coming on. So we suggest that you keep invested, but using options to build conditionality into your portfolio. And currently, we think that the appropriate strategy would be cover calls on both a basket and single name exposures.
Howard, I guess when it comes to specific indicators or what investors then should closely be tracking when they're trying to figure out the best time to buy these calls, when they're trying to figure out when is the best time to gain some of that exposure, what's the best way to do that effectively?
Yeah, we take a look at specific names and we look at what the implied volatility in that name is. If you hold the single stock, we would suggest that you write out of the money calls. If you don't, Curves has some cover call single name ETFs that you can gain exposure. But we take an example like Tesla. Tesla's volatility has actually gone up since November from 65 to 75. And if you write a out of the money call, so the stock can still appreciate 10, 15%, but without hitting the strike. But at the same time, you can clip some coupons and get income for your position. And if the stock goes down, the call actually creates less of a beta. So if you write a 30 delta call, your exposure to the stock is about 0.7. So if the stock goes down by 1%, your total exposure will only go down by 0.7%. So that's in some ways a defensive mechanism when the underlying corrects. So we think that would be a good play or exposure to protection to put in your portfolio.
Howard, we're talking about tech specifically, but you've been watching the markets a long time. I'm interested to get your take on the broader market action we saw this week, Howard, because it was a roller coaster. Obviously, the market was surprised by the Fed decision on Wednesday. The PCE comes in today a bit more muted, and we had a nice pop to the upside. What do you see ahead, Howard?
Yeah, we weren't actually that surprised. Our base case was always that the market was pricing in too many rate cuts for 2025. Given the big rate cut we had earlier, the 50 basis points rate cut, it was pretty consensus that we were going to get a 25 basis points rate cut. But I think what maybe the question is, why would the Fed commit to further rate cuts without knowing potential effects of fiscal policy coming in from the new administration, right? We know if things do get implemented as they were during the campaign, we know that the trade policies and immigration policies generally would lead to a tighter would be inflationary, right? And I have to caution that it depends on how it's implemented. But on a broad basis, it could be inflationary. So why would the Fed commit to further rate cuts without actually knowing the uncertainty of fiscal policy? So I think they actually did the right thing, which is to commit less and be able to adjust their decisions based upon what the market environments, the consequences of the fiscal policy.
Howard, great to have you on the show today. Thanks for your time. Enjoy the weekend.
Great, thank you.
Time now for what to watch next week, starting off with next week's holidays. Christmas Eve is on Tuesday, and the stock and bond markets will both close early at 1 p.m. and 2 p.m. Eastern, respectively. Both closures will also extend into Christmas Day on Wednesday.
Moving over to housing, monthly new home sales numbers are coming out on Tuesday morning. Economists forecasting the month-over-month number for November to increase to 665,000. This coming after new home sales plunged to 610,000 back in October, the lowest level in nearly 2 years, and a 17.3% drop from the month before.
And taking a look at the economy, we'll be getting a new consumer confidence print for the month of December on Monday morning. That number expected to go up on a month-over-month basis to 113, giving a clear picture of the health of the consumer.
And finally, new weekly jobless claims data is coming out on Thursday. Economists expecting that number to tick up to 222,000 compared to the week prior. The new data providing more insight into the state of the labor force. We want to get to some breaking news. A jury delivering a mixed verdict in the Qualcomm ARM trial. The jury finding Qualcomm had properly licensed its central processor chips. Qualcomm shares rising on the news and after-hours trading. You've got ARM moving to the downside. The case revolving around technology that Qualcomm had acquired through its $1.4 billion purchase of Nuvia here back in 2021. You can see Qualcomm shares, Josh, moving to the upside here in after-hours market, up just about 2%.
This one has been interesting, Shauna, because of the relationship between these two. Qualcomm is an ARM customer partner, but we've had analysts come on the show and also point out, of course, they've increasingly become competitors too, and the ramifications between these two, obviously, as well, because how many of the big tech companies we talk so much about, they rely on IP from ARM. Of course, they also rely on Qualcomm.
Exactly, and that I think just speaks to the significance of this case, just given how important these products are, or how big of a factor these are when it comes to many of those integral products here, when it comes to computers, when it comes to cars. Obviously, the implications here and what this means more broadly speaking. But again, that jury did find Qualcomm did not violate the licensing agreement by using ARM's chips designs without paying that higher rate. We're seeing Qualcomm move to the upside here in after-hours trading. That does it for today's Market Domination Overtime. Be sure to come back Monday, 3 p.m. Eastern Time for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's a recap of Yahoo Finance's year-end awards for 2024. But first, a look back at some of the highlights from this week on Yahoo Finance.
The committee decided to lower the target range for the federal funds rate by a 1/4 percentage point.
I would almost describe this as a bit of a light pivot from Powell.
I don't think there's any risks of doing a cut right now. I think there's a risk that they're saying that they're not going to cut rates even more.
But we're in a good spot with monetary policy where we can react.
Shares of the chip maker did fall into correction territory on Wednesday, dropping by 12% from its November highs.
And this is not the end of the world for NVIDIA, but it's under the microscope.
We're big fans of NVIDIA. We own shares there. But here you want to sort of go off into the areas where the valuations might be better.
NVIDIA is still absolutely dominant in this space.
Many companies had a chance to shine this year. There was one that shined the brightest, making Walmart the pick for Yahoo Finance's Company of the Year award.
We're clearer now on what our plan is, and we're on with execution. You can see some of that in the results.
It's good that the investor community has recognized some of the progress that we've made as well.
It has been a year of records for the markets. The S&P 500 breaking 6,000, the Nasdaq topping 20,000, and the Dow closing above 40,000 for the first time. These achievements happening thanks to rallies fueled by Trump's election win, the start of the Fed's rate-cutting cycle, and of course, the advancements in AI. Now, for many years, Yahoo Finance has crowned one company as Company of the Year, but this year, we decided to go bigger with a suite of awards, including Comeback, Surprise, and Product of the Year. But while many companies had a chance to shine this year, there was one that shined the brightest in its field, from generating profits that outpaced the S&P 500 to its stock price outpacing key competitors. This company has become a force to be reckoned with in retail, making Walmart the pick for Yahoo Finance's Company of the Year award. I got the chance to sit down with Walmart CEO Doug McMillon to chat about their big year and the road ahead. I have told the Yahoo Finance team something has clicked at Walmart past 18 months. Something unlocked, something got unleashed. Like, what happened? Because your sales have accelerated, your profits have accelerated, and I don't see that happening at many of your competitors.
I go back to before the pandemic when I think about that and the work that we did to make some investments. We invested in wages for our associates. We invested in our people, things like education. We invested in lower prices. We invested in e-commerce. We invested in technology, all within a pretty tight period of time. That obviously creates some pressure on the bottom line, and that creates some overhang for how people think about Walmart. But if you get to the pandemic and you look at how behaviors changed, and curbside pickup, for example, grew at a much faster rate, delivery grew at a faster rate, that was work that we had already done before the pandemic that bore fruit during that period of time. And I think it caused a lot of people, customers, our associates, to recognize that we were on the right track. And we just kind of haven't looked back since then.
Every earnings report I've read from Walmart this year, maybe even a little bit last year, you're calling out upper income households, market share gains from upper income households. Why do you think you're gaining their dollars? And where do you think they're coming from?
I think, number one, we made things more convenient for everybody. Everybody wants to save money and everybody wants to save time. But it's a bit of a continuum depending on your income level. And in the recent years, we've changed enough things that make it more convenient to shop at Walmart that we've been able to retain people that make more money.
Why are prices still high for stuff?
Over the period of the pandemic, when supply chains got stretched, a number of things happened. Input costs went up, and so new levels have been reached that in some categories won't go back down. Now, general merchandise, things that are not food, has come back down much faster. In fact, we're right now in the US, we're deflated by about 4%. Fresh food is moving around quickly. We're just talking about eggs. Unfortunately, eggs are high right now. Some of the other categories have come down. Those cycle times are quicker. Dry grocery, consumables, kind of processed food and things like paper goods and cleaning supplies have been more stubborn. And they're much higher than they were 3 or 4 years ago. And we're obviously trying to work with our suppliers to get those prices down.
On the international business, also very, very strong year, really by country. Walmex, the Sam's businesses in China.
Yeah.
What do you attribute that to?
You've followed the company for a long time.
Back to Asda.
You've seen us, yes. Yeah. You've seen us make investments in new areas like Flipkart and PhonePe in India. You've seen us exit some other markets. So one, we're in good businesses. Number two, we have leaders in the markets that are really capable. And then some of the other things we've done, the IP that's flowing across markets now with this strategy that we have, the tech that's flowing, supply chain expertise, the work that people are doing together to make the total greater than the sum of the parts is showing up in our international results.
Do you get concerned that, some of this momentum pulls back if we have a trade war?
We want prices to be low for our customers, and we want flow to go smoothly. So when we interact with governments, all governments, we try to advocate for that consistency. In the case of the U.S., we've had tariffs in place in various forms forever, I suppose, and a batch of tariffs that happened in 2017 that we're used to operating with. So, we're positioned to manage it, but what I worry about is customers experiencing higher prices, and we're going to do everything we can to try and keep them low.
Would it be easier to make more things in the U.S.? Is that possible?
It's growing. We work really hard on that. State by state, supplier by supplier, and we're making progress. Our U.S. percentage has been going up. We've established some big goals related to that.
Is this the year that a lot of tech initiatives that you put in place, maybe when I first talked to you in 2017, that they start to unlock? Like, what are the biggest tech initiatives that have changed Walmart?
In my experience, not some sort of breakthrough year. It's just a continuum. It's just been progress, dealing with tech debt, modernizing our architecture, creating more speed on front-end applications. If you look at kind of big picture what's happened in Walmart in recent years from a customer point of view, is you still have low prices, and now you've got access to hundreds of millions of items on Walmart.com. It's not just the store assortment. Walmart's different than it was before, and you get convenience. So recent survey results have shown that customers are giving us about as much credit for convenience as they have price, and that was not the case before.
How do you think Gen AI is going to impact your business? Like, if we're having this conversation 5 years from now, what changes will I notice in the store? Or maybe things I won't notice and they'll just magically show up on your earnings day?
I'm really excited about what's happened already, and it's an energizing experience as leaders to have to learn and apply so quickly. The cycle times as it relates to generative AI are much faster than a lot of the technology, maybe all the technology that I've dealt with in my career. It's going to help us be more anticipatory for customers and members. Search is going to change. The world will look more like personal shopping assistants than it will an old-fashioned search bar with a laundry list of results that you and I then have to work through as a customer. Just saving us time, making it more convenient, helping us solve problems. In the past, if I wanted to throw a party for the college football playoffs, I was typing in soft drinks, chips, dip, whatever. Now I say, I'm throwing a party for the college football games. What do I need to know?
What does that next 10 years look like for Walmart?
Continued growth in the areas that we've already started. We probably launch some other new businesses along the way, and we keep changing everything we can to take all the stuff that people love about shopping and dial it up and invent new things related to discovery or other aspects of shopping that we love doing, and take all the things we don't like and try to get rid of them or diminish them. And technology will do that. Innovation that we as leaders and associates contribute to it will help do that. I think it's as simple as that. We're going to keep trying to make things better for customers.
Coming up, we'll reveal which legendary American company brushed off many challenges that have come its way, leaving Wall Street dumbfounded and securing its place as our surprise of the year. While there's been a lot to cheer for in 2024, the year did not come and go without its challenges. One company especially has been able to unexpectedly rise above several hurdles and race toward a strong finish. Yahoo Finance's Surprise of the Year award goes to General Motors. Here's what GM's longtime chair and CEO Mary Barra told me on the winding road for the automaker. Mary, great to get some time with you again. Congratulations on this award. We appreciate you joining Yahoo Finance. I know it's been a busy time. My first question to you here is, as an executive in the trenches all year, does your performance this year feel like a surprise to you?
Well, I think I'm so proud of the team at General Motors. They've all worked so hard to be able to deliver the strong performance as well as great vehicles. It's all fueled by vehicles we've been working on for a couple of years. We have the strongest internal combustion engine portfolio we've had in a long time. And this, what for General Motors, was the year of EVs. The portfolio of EVs that we have that cover the different segments from luxury to value, it really has given consumers choice between ICE and EV. And I think that's what's fueling our profitability. And people are starting to say, look and say they understand that this is a company that is differentiating itself in the industry.
What surprised you about the business as the year has gone on?
Well, I mean, there's been a lot of change. We're an industry in transformation, and GM itself is in the midst of making sure we're ready and proactive for the changes that are coming. But I think what was a pleasant surprise to me, I don't know if I'd call it a surprise, but I really felt validation for the team on how well received each of our EVs were.
You know, as you look back over the past few months, is there something that you would have liked to move faster with and that you're really focused on for next year?
Well, I think this year was really, again, getting the EVs out there to get the scale, because scale is going to be so important to drive to profitability. So next year, we'll continue to build on that, hitting more milestones of how we improve the profitability of our EVs. I think also we made some difficult decisions this year to set the business up for success, because we're trying to really be proactive and look at where is the business going. So the restructuring that we did in China and the pivot that we did to cruise, make no mistake, we are still 100% committed to autonomy, but we recognize there's quite a bit of capital that needs to be deployed into the rideshare business, and we want to deploy and work toward improving Super Cruise, getting to L3, L3 plus on our journey to L4.
You have Tesla wanting to drop robo-taxis, you now integrating your technology, Super Cruise technology into your vehicles. Are you not a believer in robo-taxi? It's not just a Tesla thing. We've heard also Uber, may want to have interest in this.
Well, I think robo-taxis are going to be important to get to really, I'll call it rideshare 2.0. We just looked at it, and operating a fleet of vehicles and all of the associated services and operations that are needed to do that is not our core business. We sell beautifully designed vehicles to consumers and to fleets, and they love technology. I mean, the feedback we get on Super Cruise is when people experience it, they say, 80% of them say, I wouldn't want to buy a car without it. And so as we looked at those insights and we looked at how we could accelerate our work in driver assistance technology, getting to L4 autonomy, we thought it was a faster path, a more focused path. And, our plan is to bring the two teams together, and between the expertise that we've brought into General Motors and the tremendous expertise that Cruise has, we think we can move faster and differentiate ourselves in this space as well.
You put a real flag in the ground many years ago, Mary, said we're going to be making all electric vehicles by 2035. Is that still your North Star and your hope?
Well, we still have a plan that allows us to get there, and so we're still executing to that plan. But the most important thing, and I've been saying this for a couple of years now, is we're going to be guided by the consumer. We want to give the consumer choice. What do they want to drive? We don't want to get into a situation where regulations are driving us to force something into the market that's not what they want. But I think once people start to drive an EV, they realize it's instant torque, beautifully designed. At least General Motors vehicles really give them a lot of technology in the right segments. And then not having to go to the gas station, and the benefits of EVs, I think, is something that people are going to move to because it's a better product. What we need to do to accomplish that, though, is to have a robust charging network. And that's what GM Energy is working on with a number of partners.
Mary, I was just talking to the CEO of an apparel maker, and she was making the point, if we get tariffs I could take what I make and move it to another country. But you can't do that in the auto business. I mean, you can't erect a new factory overnight or within 6 months. I mean, these are big buildings with machines, and you do make things in Mexico and Canada. I mean, how fast can you react if we get hit with tariffs?
Well, it depends on the product line of where we have production, because in some cases we have production in multiple plants. But I think what we want to make sure is people understand what the implications are and what it means to the U.S. economy from a jobs perspective, from a pricing perspective for consumers. So we're going to continue to communicate with all of the governments, and hopefully we'll get to a good decision. But either way, we're proactively looking and considering all the options that we have, so we'll adjust as appropriate.
Now, we can't look back on 2024 without talking about market darling NVIDIA. The chipmaker continued its dominance from last year and is looking to stay ahead of the competition with its next generation AI chips, making Blackwell Yahoo Finance's choice for product of the year. Julie Hyman explains what makes Blackwell a cut above the rest.
Julie, I know you've done some amazing reporting on why this chip is so beloved.
Yeah, I mean, I will mention one of the ironies of this being picked as the product of the year. The thing didn't ship till the fourth quarter, right? But there has been such anticipation and such demand from the hyperscalers to get it to power their data centers and their large language models that's why we named it the product of the year. So if you look at some of the specs on this chip, and listen, I am not necessarily a semiconductor expert, but the numbers sort of tell the story here. So it has 208 billion transistors. That is more than 2.5 times that of Hopper, which was the predecessor chips. And then there's something that NVIDIA talks a lot about, and other chip makers too, which is the so-called total cost of ownership. Blackwell is expensive. It is the most advanced and therefore the most expensive GPU on the market. However, NVIDIA argues that because it is highly energy efficient, the total cost of ownership over the lifetime of the chip makes more sense. And then it's not just Blackwell that NVIDIA is selling, it's really a whole computing system. So it combines with the Grace CPU for a full rack of computing power. That's what's going into these data centers. Now, CEO Jensen Huang, he rolled this out. He first introduced this in March. And here's what he said about Blackwell at the time.
There's no memory locality issues, no cache issues. It's just one giant chip. And so when we were told that Blackwell's ambitions were beyond the limits of physics, the engineer said, so what? And so this is what happened. And so this is the Blackwell chip.
So it's showing there the physical chip. It is the largest GPU ever made as well, we should mention. And it's made by using two die, basically two chips that are connected by a high bandwidth interface. That was one of the leaps, the innovation leaps that NVIDIA made in developing the chip. You can see what it's already done. Well, if you look at the revenue growth that we've seen for NVIDIA already, as I said, Blackwell didn't actually ship till the fourth quarter of the year. So a lot of this is demand for other data center chips like Hopper, what we've seen thus far. But the real surprise began for NVIDIA, not this year, but last May when we had that big upside surprise in revenue. And then the company's revenue has just continued to grow here, although at a somewhat slower rate, the bigger it has gotten, Maddie.
What are your sources telling you just about the path forward for NVIDIA and whether Blackwell will be enough to keep NVIDIA as the leader?
So let's be clear here. NVIDIA is still absolutely dominant in this space. When I talk to analysts, I talk to Ben Beheron, I talk to John Vinn over at KeyBank, and they talk about 80% plus of the control that NVIDIA currently has on this data center generative AI LLM market, right? So they are hugely dominant. And when you look through the next year, Vin said, as long as they can solve some of their manufacturing bottlenecks that they have had and get the flywheel going, then they'll be fine. Yes, the revenue growth is expected to slow, but again, that's because they're coming from higher and higher numbers, and demand doesn't seem to be of a concern. The competitive threat is going to come from custom chips, most likely. AMD, yes, but Broadcom, as we've been increasingly talking about, got a lot of attention in its most recent report, talking about the increase in demand for custom chips. But again, when I talked to analysts, they said the custom chips aren't there yet. They are not yet competitive. They're going to chip away, they're going to increase, and at some point maybe they will be there. But if you look over the next year, doesn't seem like that is yet happening. You have to maybe look further out to see the changes that are perhaps going to come.
AI has certainly been a top theme of 2024, but so has one asset class, crypto. And in that space comes our pick for comeback of the year. Find out who it is on the other side. Crypto making a grand return to the spotlight in 2024, with Bitcoin topping $100,000 for the very first time. But which name stood out to win Yahoo Finance's comeback of the year? Well, that honor goes to Robinhood, as the company became consistently profitable while delivering a host of new products for investors. Here's what co-founder and CEO Vlad Tenev had to share with me on the company's comeback journey.
I think for people to understand what has happened to your business, we have to go back to some of those like lower points in the business for you, for as a leader in a business. I mean, what were those like, and how'd you get out of them?
I think 2022 was challenging, and 2021 when we went public actually had some stress as well. I remember when we entered the public markets. I mean, it was sort of at the height of the secular bull market, and we felt good, but the business now is much stronger across pretty much all dimensions. We have 9 business lines that are generating over 100 million in annual revenue. Business very diversified, growing across our main priorities of active trading, growing wallet share for the next generation.
Big year for the company stock price, big year for your company financially. This could be a really different company 10 years from now? Like, what is your vision for Robinhood?
I think the vision really is for anyone, anywhere in the world, whether you're an individual retail investor or an institution, Robinhood should be the best place for you to custody all of your financial assets and process all of your financial transactions. And so it's expanding across the two dimensions I mentioned earlier, going global, where we've got lots of winds blowing. The rest of the world is getting wealthier. It's going to the technological frontier. Mobile penetration continues to go up. Internet is becoming ubiquitous. There's multiple trends that are moving towards more self-directed, more focus on US products and US markets, and AI and cryptocurrency sort of booming at the same time. And Robinhood can really be at the center of these things and I think those are going to be the growth drivers in the financial industry over the next 10 years.
How happy are you that Gary Gensler's out the door and we have potentially this guy, Paul Atkins, who sure seems bullish or more bullish on crypto than Gensler?
Yeah, I mean, I think that Paul Atkins, we're very excited about him taking on the mantle and getting the agency pointed in the right direction again. I think the American public wants to know that regulation is here and that they have standard protections. There's good reasons for regulation in the first place. You want to avoid all the downsides and all the hard lessons we learned in the traditional financial markets that led to it in the first place. And we're very optimistic about that. And we're also looking forward to the end of the regulation by enforcement approach that has been bad for the industry, frankly, and bad for the public in the US.
If investors are trying to make sense of this move in Bitcoin and other cryptos, what do you think happens in the first year? What's the biggest unlock that you would like to see in the crypto industry from this administration?
Well, I think there will be a push for comprehensive crypto legislation. There's a stablecoin bill that got battered around a little bit, never made it to the Senate. That will probably be reproposed, maybe in a slightly different form. So there's talk of a Bitcoin strategic reserve, and I think if that happens,
what does that do to a business like Robinhood?
Well, we've been early to crypto, and we're one of the few public companies that actually has a large crypto business associated with it. So as the industry grows, I think Robinhood is well positioned to benefit from that.
When you look at the company, like how you made some comments on sports betting. I was trying to figure a way to ask it, but do you want to be that broad? I mean, are you going to go toe-to-toe with Yahoo Sports? I mean, what's your ambitions? Clarify that stuff for us.
I think that was taken a bit out of context. There was a question about the election product we rolled out. So we're going to broaden that. We're going to have a more expansive regulated events offering, and these are CFTC derivatives. So federally regulated. There's all kinds of contracts and events that are permissible that we'd want to allow people to trade.
Do you have ambitions or view that you want Robinhood to be this generation's JP Morgan?
Well, one of the things we care about, this is the second arc, our 5-year arc, what we call it, to be the leader in wallet share for the next generation. And right now, Robinhood has more millennial and Gen Z customers than the leading brokerages.
Millennials?
Millennial penetration and Gen Z is even higher, actually. So we see an opportunity to help them with all of their financial needs with an emphasis on multi-generational needs. So we want to serve their parents, their kids, and I think that's something that the existing industry players don't get right. Nobody has a great kind of like family, multi-generational experience. And I think there's low-hanging fruit there. If we serve the whole family and really have a great integrated experience, which our recent acquisition of Trade PMR should help facilitate. I think Robinhood can be the place where, you actually like stick with.
That's a wrap on Yahoo Finance's 2024 awards. Thank you for watching.